Hi, and welcome to Street Check. I am your host, Brad Simmerman. My co-host, Chris Preston, out ill today. He will not be joining us, unfortunately. So I'm going to be flying solo through a little bit of news today. And then I'm going to be joined by Tyler Laundon of Cabot Small Cap Confidential and Cabot Early Opportunities. And he and I are going to have a little bit more of a conversation in this conversation-focused podcast. But before we get there, you are going to have to deal with me monologuing some news. Today, we're going to talk a little bit about the UK trade deal. We'll cover the most recent Fed meeting and Warren Buffett sign off. He has announced that he will be retiring at the end of this year from his role at Berkshire, likely to stay on, probably in some capacity on the board as maybe a chairman. That's been floated, but we'll get into that a little bit later. To begin with, the big announcement this week, UK trade deal, obviously drew a lot of attention. That was something that President Trump had announced on Truth Social as being pending. And he had a joint press conference yesterday with Starmer of the UK. They announced a little bit of a revision to the tariff plan. So, as part of this deal, the US has opted to partially rescind 25% tariffs on autos and auto parts. And I know that a lot of the headlines are saying that this is a full reversal of those tariffs, but it's actually a little bit more nuanced than that. It is a reversal of the 25% tariffs on autos that are imported into the US, but only up to the first 100,000 cars. So that's going from 25% down to the 10%, which is essentially the baseline rate that all these tariffs are operating on. Anything beyond the 100,000 cars imported into the US, which was the number of imports into the US in the most recent calendar year, is going to be subject to a 27.5% import tax. That's the biggest export to the US. That was about 9 billion pounds. So somewhere in the neighborhood of $12 billion. Additionally, there's not going to be additional tariffs on steel and aluminum, but that is similarly unresolved in that it applies to products that are also made of steel and aluminum, but there's a lot of details to still work out there. The big open question is pharmaceuticals. That's the fourth biggest export of America to the UK, and it's the US's second largest import at around 6.6 billion pounds. So close to 9 billion US dollars. And then for the time being, there's no change in the digital service tax. So it's probably not as optimistic as the headlines have pointed out, but it's certainly better than what we were operating with, which, again, just large disproportionate tariffs. It's still a work in progress. Any kind of comprehensive trade deal is going to need to get signed off on by Congress, but that has not really stopped the imposition of tariffs thus far, and by all measures appears unlikely to do so going forward, but we'll sort of have to see how it plays out. So from an investing standpoint, really not a big change. It doesn't reset expectations. It's not like it's not like a trade deal with China, which could be much more meaningful. The US does import from the EU, but it's the scale of it is just a lot smaller. So progress, the risk that the negotiation sets up is that other world leaders are going to see this as maybe being a step back, or something that we have talked about previously, the idea that President Trump is blinking and that they will then be able to simply wait it out, or wait it out and then engage in increased trade with other global partners. So it's something of a win. It's certainly better than, rumors of trade deals, but it's far from a banner announcement for stocks. We'll continue to see how this develops. I know that Starmer had said something along the lines of, in the weeks to come, more of these details would be hammered out, and we'll see updates as they're available, and we'll convey those to you if they're meaningful or relevant. Also this week, we had a Fed meeting. This meeting did not come with a summary of economic projections. So no update to how the Fed is thinking about things, and that really was conveyed as well in the press conference with Jerome Powell after the rate hold was announced. Um, the biggest takeaway was that this is the economy is showing enough strength where they can continue to take a wait and see approach. So obviously, no rate cuts. They Powell signaled that the unemployment rate is still holding around 4.2%. Also signaled that something that I think everybody is largely aware of, that the front loading of imports before the imposition of tariffs made GDP look a lot worse than it may have looked otherwise. And that's something that could be captured in GDP revisions as they come out. It's also something that may be reflected in improved inventories in future quarters. So Q2, maybe all the way up to Q3, depending on how these are received. There is, a multi-month lead time for orders that are made and invoices that are paid before those goods actually get to our shores. For the time being, though, the market had been pricing in 97.5% chance that this would be a hold. It was a hold. So really not a lot of surprises in the meeting, nor much to take away as far as like forward guidance. The Fed is very sensitive to the risks as they are, and they did field a couple of questions about, well, they being Powell specifically, did field a couple of questions about interest in or need to make preemptive rate cuts, and Powell was very resistant to that, and essentially reiterated the position that he had stated before, which was economy's generally healthy, not seeing big spikes to unemployment, no real worrying signs under the surface. So inappropriate to start cutting in anticipation of the impacts of the tariffs. And the one thing that really I think makes that an appropriate stance for the Federal Reserve is that, as we saw with the trade deal announcement with the UK, these are sort of moving targets. So, as something that we have talked about before, certainly that I have talked about, is the difficulty that businesses face trying to anticipate what the impact of the implementation of tariffs might have when they could change at any moment. The Fed is in the similar position. They can make reasonable expectations, but they have been very data driven for the last few years. I'm sure everybody listening to this or watching this remembers the inflation is transitory talk that we got for the better part of a year. And that's because they were looking at the underlying data. They were trying to make reasonable expectations based on that underlying data. So they're not looking to start slashing rates. Frankly, I will be surprised if they're cutting rates in the June, July window. We would really need to see that tariffs have no net impact on inflation, and we would need the economy to continue to hold up. And thus far, it's showing signs that this is something that we can probably work through. Certainly, that's what the market's reception has been. Obviously, we've since recouped all of the post-Liberation Day losses. The market has bounced back very strong. So we are very much in wait and see mode with the Fed, and I guess this will go back to being the official Federal Reserve podcast with the pace that things are progressing right now. The last item that I wanted to touch on this week, Warren Buffett announced his retirement from Berkshire Hathaway. That'll be effective at the end of the year. The Berkshire stock took about a 5% haircut on the news. That's a reasonable move for Berkshire to take with somebody that is arguably the greatest living investor opting to step aside from the company, but it's well earned. The man is in his 90s. He's got a strong track record of 20% plus annual returns almost every year. He's one of the few investing names that even people on Main Street are going to know. So he has earned his retirement, certainly. If you are an investor in Berkshire, I don't think this is something that you need to panic over, right? Warren is probably going to stick around and is in some capacity, at least maybe in an advisory capacity. And it's a reasonable assumption that if he is with as diligent as he is in identifying investments, he will be at least as diligent in identifying a potential successor. So we'll have to see how that plays out. We can take a little bit of a takeaway from something that happened, what, last year, 2 years ago, with the passing of Charlie Munger. Daily Journal was the company that he had run that similarly suffered from an immediate sell-off right after he had passed. So, both of them sort of parting ways with the companies and bounced back and has stabilized and performed quite well since. That's a reasonable expectation to have for Berkshire shares going forward. I mean, obviously, the deciding factor for Berkshire is going to be the broader market environment, and then I think Buffett has certainly bought enough goodwill for his successor to maintain positions, to give it time to play itself out. If it turns out that he's done a poor job of identifying a successor, if if they start implementing a dividend, that would be one indication. He has always historically been very resistant to that because Buffett's stance is that he can do better with the cash than for his shareholders than his shareholders would do from simply receiving excess cash. So if you see an imposition, or if you see the implementation of a dividend, then that might be a signal that the brain trust at Berkshire is out of ideas, or maybe not as confident in their picking as Buffett had been. But for the time being, really nothing to worry about. We've got at least until the end of the year where Buffett's going to be in place. And, obviously he'll likely give some more information about what the transition plans look like. If there's going to be any kind of change to how the company is managed, we would expect to see reporting on that as well. But, living legend, couldn't go without mentioning. So I think that's going to cover it for our news. I am going to bring on Tyler Laundon, who is going to talk about small cap stocks and identifying them, talk about gold as well. If you happen to miss his webinar that was yesterday, May 8th, then I highly encourage you to go to the cabotwealth.com website, go to the free resources and then free webinars. Under that, you can watch a replay. But for our listeners, we're also doing a special offer this week. You can get Small Cap Confidential, it's Tyler Laundon's Small Cap Advisory, for $997 for 1 year. That's a 50% discount to the normal price of $19.97 a year. That also comes with a 30-day 100% money back guarantee. And you'll get all of Tyler's insights into the small cap stocks that he likes best, the positions that he's adding to his portfolio. He really does an excellent job of presenting what is institutional level guidance and analysis on these small cap stocks that frankly don't often have a ton of analyst coverage. So if you're looking for some insight into what it's like to maybe be running a hedge fund and take a look at like actual highly professional analyst coverage of small cap companies, you really can't do much better than Tyler. So with that out of the way, we are going to take a quick break. And when we come back, we will be joined by Tyler Laundon. Okay, welcome back to Street Check. Now I am joined by Tyler Laundon, who will be filling in as my co-host for the rest of the episode. He's the chief analyst of Cabot Small Cap Confidential. Tyler, how are you doing?
I'm doing okay. How are you doing, Brad? Thanks for having me.
I'm doing good. I'm flying solo. The energy's better when it's just me, I've noticed. But
Well, hopefully Chris
let's.
isn't listening.
Oh, he doesn't listen to this. No, I'm kidding, Chris. I hope you feel better soon. All right, let's get to the market. Let's just start talking about market as a whole. Obviously, tariff sell-off in April, and we've fully bounced back. What are you seeing in the broader markets right now?
I'm seeing a sneakily strong market that kind of reminds me for a whole lot of, different reasons behind it. But as far as like the market's action goes, I don't remember exactly when it was, but like last year we saw the emergence of like a sneaky bull market. And I'm not saying this is a bull market, but stocks are doing very well since the lows were put in after Liberation Day. We had what a stretch there of what, 7 or 8 days in a row where the S&P 500 was up. And, it's super confounding to try to analyze it and figure it all out because we have all this soft sentiment noise, right? Um, and there's been a lot of volatility with people's emotions for sure. But when you look at what the market is doing, we're back above the pre-Liberation Day announcement, and it's really interesting. I was slacking with Jacob a little bit this morning. There are a lot of small and mid cap stocks that are just up 15, 20, 30, 40% on earnings announcements. And whether that's evidence of short squeezes or what. There's a lot going on out there, and it's leaning more positive than negative as far as stock reactions are concerned. So it's an interesting time.
Yeah, one of the things that caught my eye when I've been looking at this is retail really did not sell. Retail, I think, net bought from like April 2nd to like the 10th by something in the neighborhood of like $4 billion. So we had sentiment fall off a cliff for retail investors, but they just sort of grinned and bared it, bore it, grinned and bared it, and held on to positions. They were really not dumping much. It's been a strange market because we'll see even on a day-to-day basis, we may gap up at the open or pop a little bit higher at the open, and then you just get the steady buying pressure all day before the last 10 minutes come in and market makers just sweep the legs out from it or push it back to lows. It seems like it's been very structured buying, and it's been fairly well contained just from what I've been seeing technically. Um, it is part of me wonders if like retail learned all the lessons from the past couple of years, especially from COVID, and maybe it turns into the wrong lesson, and that smart money is actually selling into a lot of these rallies. We are sort of capped by a lot of overhead resistance right now, but it doesn't seem like we've had, despite the sentiment measures being bad, it doesn't seem like retail investors have been responding in the same way with their portfolios.
Yeah, it's going to be interesting when the hard data comes in, whether or
Right.
not it supports that, like that softer sentiment data or not. Like you just said, and you're obviously in tune to it as well. But yeah, the S&P 500 is just below its 200-day moving average line, and just below the level from April 25th or so, which of course was a week or so before the Liberation Day. You know, Brad, what you just said there about retail investors holding it, you have to wonder, like this Liberation Day sell-off, yes, it spanned a weekend, right? Uh, 2 or 3 days afterwards, but it was so fast. It
Yeah.
was like 3 days down. It was like bang, bang, bang. And then you get into the next week and Trump does what he does and says what he says, and the market soars. And you have to wonder if the average retail investor who's just not watching the market like every day just couldn't get out of the way of it fast enough. And by the time they saw it was down so much over 3 or 4 days, they're like, yeah, you know what? It's too late to sell. It's time to buy, if anything.
Yeah, I like that. I like the perspective a lot. They just get caught flat-footed, and then by the time it's down, if you're in large cap growth stocks or tech stocks, you're like, all right, well, I'm down 18% or I'm down 24%, depending on whatever you're holding. It's like at this point, I feel like I've taken enough of a loss. I'm just going to hold and hope. Um, oh man, I had a question I was going to ask you, and I just lost it. This is podcasting. Um, yeah, so retail investors maybe get a little bit caught a little bit flat-footed. I do think the tough thing with that pace is like trying to time an entry, right? Because on the one hand, if you got out when you're down 5%, it's like, okay, well, we're down 20%. Are you trying to catch a falling knife? It's easy to forget that the selling really started in February, right? Like it wasn't induced by tariffs. It was induced by high valuations and maybe a few questions about the economy. It was just accelerated by the tariffs. So while some of this deal making and delays and stuff like that addresses the tariff risk, it's still coming from an environment that was taking a more bearish posture. So, part of me wonders if uh, some of the big buyers are just letting the market catch its breath a little bit to maybe start taking us a bit lower. Um, I think if
Y-
you're, oh, sorry, go ahead.
I was just going to point out one thing that kind of speaks to what you just said about how the market had been weak earlier. I was watching Microsoft and it hit what a 52-week low on April 7th, which was, before Liberation. I think was that before Liberation Day? What was
That was
Liberation Day?
that
Was it
was
April
uh
3rd?
that was right after would have been right after Liberation Day. So yeah,
Okay.
selling started early in the year, and then the Liberation Day thing was just sort of a nadir. Um, obviously Trump backing off or at least signaling that he's backing off or with risk coming from the bond market is like a big factor. That I think that stems all the bleeding. And Chris and I have talked about that before, where it's like as much as in the past he's looked at the stock market as a scorecard, that seems to not be the case the same way. But when push comes to shove, he has at least signaled that he's making some moves or he's not interested in bringing it all down. Um, all right. Well, let's move on from the general market chat and just let's take a look at gold really quickly. That's something that has been rattling around near $3,400 an ounce, near all-time highs. It's been doing really well as the dollar has weakened, but as the market is sort of bouncing back, gold has flattened out a little bit. So how are you playing gold right now? What are you looking at?
Yeah, so we just did a webinar on this yesterday, so timely questions. I think gold is one of those things. I mean, for like Cabot Small Cap Confidential and Cabot Early Opportunities are those are really the things that drive my motivation for following something like gold, trying to get stocks into those advisories that subscribers can do well with. And I'm not like a huge gold bug or anything, but
No.
um, when gold is doing well, these mining stocks can do so well. And there's some pretty exciting stories to follow. A lot of our subscribers on, at least on Small Cap Confidential, get really invested and interested into the stories of a developing company. And so what you see, of course, is that when the price of gold is high, there's obviously more financing available out there to for small and micro cap companies to raise money to go out and to drill. And there's some pretty exciting things happening. And I mean, the last time we were in a real bull market for small and micro cap gold companies, it was many years ago, but it went on for a lot longer than people expected. And you don't necessarily need gold to shoot from, 3,000 an ounce to 4,000 an ounce to power that. You just need it to be relatively strong. And so I think that we're going to be in an environment now, at least the thesis that we're going with in the publications is we're going to be in an environment for a while where gold is going to be relatively strong. And that's going to support some sustainable interest in some of these smaller companies that are going out and trying to develop uh, gold mines. And there's a whole bunch of stuff that goes along with that, trying to figure out when you want to buy those stocks and when you want to sell them. It's not necessarily a buy and hold space,
Yeah.
but that's, we don't want to go crazy talking about that. But anybody that jumps into our service, they'll find some small companies that are very early stage, and yeah, they're pretty exciting and they're pretty interesting.
Well, the natural resource angle, I think, is probably very promising, just given the sort of political reality that we're in right now, where it's a deregulatory environment. I know there is opening up of some sort of, natural park resources for like timber harvest. Presumably, that will also lend itself to more opportunities for like mining and extraction and stuff like that. Do the
Mhm.
do the junior miners normally like lag the performance of the gold? Is there like a calendar lag on those where once gold spikes, it's investors sort of get the permission to start buying into some of the more speculative miners, and then as long as gold's holding high, they tend to outperform.
I haven't really studied that, but I mean that seems sensible. Like
Yeah.
anything, when we as investors, when we see a larger market starts to do well, over time we get more comfortable with that, and then we move down the market cap curve to the
Right.
more speculative stocks, and that's what's going on. You just mentioned about the opening up natural resources, and that's definitely happening. The Trump administration has put out some policies to fast track a number of projects here in the U.S. And there's some pros and cons to that, obviously from an environmental perspective.
Right.
Um, but one of the other things is with gold, when Russia invaded Ukraine, the US locked up a lot of reserves, like $280 billion worth of reserves that Russia held. And so I think central banks around the world that aren't necessarily friendly with the United States see gold as a way to build up reserves that don't allow for the U.S. to have as much leverage over them. So that's been one of the big demand drivers in the backdrop.
Yeah, there's been a lot of speculation that the BRICS will roll out some sort of competing central currency that's going
Yeah, the
to maybe
unit.
be, is that what they're, the unit?
Yeah,
BRICS?
yeah.
I don't know. That sounds too sci-fi to me. It's like, huh, give me 11 units and I'll be selling you X, Y, or Z. But the speculation is that they may go back to a gold backing on it. I mean, obviously, like these are adversaries. I think globally, that's probably like you can't necessarily say that about India, but Russia, China are adversarial. So it's always sort of prudent to take any kind of headlines or news announcements with a grain of salt. But the speculation is that they could be looking to leverage a gold backing for some stability. I mean, we're seeing the risks of overprinting and sort of an unmoored money supply play out as we speak.
Yeah, and that type of environment in the past has been a contributor to the first two bull markets in gold. But again, I think there's I feel like as investors, we're sort of split up into two groups where there's the people that love gold and just want to hold physical gold and invest in gold because they love it.
Yeah,
Then there's the other group that want to invest in these types of stocks as a way to diversify their portfolio or just to chase gains, just like any
sure.
other story. They might not be super passionate about gold or any more so than a software company or whatever. Um,
Yeah, that's
so I,
that's that point is well taken. I'm not buying Microsoft stock because I super love Microsoft Word or Office or anything like that. I'm buying it for return potential. So, yeah,
yeah.
well taken. Um, all right, we are getting sort of close to the end of our time. I did want to just touch base with you on small caps, given that that is your area of expertise. Are you seeing any particular strength in any categories, sectors, any areas of the market that look particularly strong for small caps right now, aside from gold?
Yeah, well, as you know, we've talked about before, I follow a decent number of medical technology companies and also some a decent number of software companies. And we just had, I think, eight of our portfolio or seven of our portfolio holdings report this week. And some of the med tech stocks have done really, really well. It's a mixed bag, across market caps, but um, a lot of the US focused ones, they don't have a lot of exposure to what's going on around the rest of the world. And there's been some good reports there. And software, if you look at like the WCLD ETF or the CLOU ETF, those have come back pretty nicely. They're not, it's not like a raging bull market or anything, but there has been some strength in there. Um, and then we've had a few other just somewhat like random stocks that sort of don't fit into a major category, at least not one that we have a lot of exposure to, like a grocery store company
Sure.
that you and I were talking about earlier today, and that stock has done very, very well. So I think that, it's still, it feels company specific.
Hmm.
Um, and it's so fresh. I still have a lot of earnings write-ups to do today. It's been hard to step back and kind of assess across the spectrum what like the big picture takeaways are. But I will say it looking at a lot of charts and a lot of earnings reports, and it's like, wow, there's a lot of stocks that we've missed that are doing really well. And it seems like there's more upside moves than big downside moves, and I think that's encouraging. Um, Maybe that's just the stocks that I'm looking at, but that's just sort of how I feel, at noon on Friday after a big earnings week.
Yeah. All right. So like if we had to boil it down, are you so overhead resistance, we set the context for the sell-off starting in February, individual outperformance. Are you a net buyer right now, or are you still in sort of wait and see mode? Or are you a net seller?
Um, I'm just a big fan of doing things incrementally.
Yeah.
Um, it's always a little bit of buying and a little bit of selling. I think for the last 2 or 3 weeks, it's been kind of like some buying, like, oh, I don't really feel that great about this, but I'm going to do it anyway.
Yeah, you
Um,
hold your nose and buy.
yeah, and I think that there's also been some buying of stuff that got so I mean personally like buying of positions that were sold during the Liberation Day sell-off just to be like,
Yeah.
you can't you sort of have to get over your mistakes, what seem like mistakes pretty quickly. The market doesn't really care whether you bought it or sold it. Um, I mean, Trump is telling us to go out and buy stocks. So, um, do we want to just keep it simple and go with that? Um, I think
It it worked out a couple of weeks ago if
it
you
worked out a
were
couple of
on
weeks ago.
Truth Social. Right. Like, but that is, I mean, that's sort of the nature of this market is you're held hostage by these headlines. I do think incremental buyer is the right play. I spent a lot of time thinking about where to where to re-enter. Like, right, like, okay, well, I can be super aggressive and re-enter on every dip. I can be moderately aggressive and re-enter once, we're clearly trending higher. Or it's like, all right, well, maybe when we get over the 50 day, when we get over the 200 day, there's like sort of all these incrementally safer steps. But if you get to the max safety, you're not buying until we're hitting fresh all-time highs. So I
Yeah.
do think that there's probably a lot of investors that are out there that are trying to figure out when it's safe to get back in the water. And I think incrementally we are sort of showing up there.
Yeah. I mean, you got to look at things over the long term, right? Maybe you can time things really well once or twice or 3 or 4 times a year with a particular stock, but if you're in this for 5, 6 decades,
Yeah,
uh, then it really is playing the long game. And there's the bottom line is if you're playing the long game, then everything is incremental. So just
yeah.
accept that and roll with it. And
Okay.
that's how I look at it.
I think that's good advice, and the numbers bear it out. Just dollar cost average. When you've got 40 years to retirement or 20 years to retirement, dollar cost average, just buy when you've got extra funds and build positions over time, and the long-term return will carry you. Last question. I'm just going to bring this up. Fed. Fed rate cuts. Are we getting any rate cuts this year?
I think we will get some this year. I mean, I've been persistently wrong on this, as you
Yeah.
know, and I know that's why you brought it up. So thank you.
Bingo.
Um, but I mean, it's kind of interesting that everybody else is cutting, and the Fed this week was like, nope, we're going to hold steady. And they kind of had to after Trump basically said you should be cutting rates. Well, not basically, but just flat out said that.
Yeah.
They've got to maintain their independence, which I think was a good look for the market. I'm glad they did. But as we know, they're just going to wait to see what the data says.
Yeah.
And so far, it's not bad.
Yeah. This should be like the silver lining podcast or this silver lining episode. It's like, yeah, everything, if you pay too close of attention to the headlines, everything could look kind of bad. But if you zoom out a little bit, everything is actually in pretty good shape. Like it's certainly not the worst case scenario. Things are looking up, things are looking brighter, which I think that's technically the market's cue to crater, is when I say stuff like that. Um, so we'll see how Friday closes. If you would like to hear more from Tyler, go watch that webinar recording. It's on the Cabot website. It's under free resources, free webinars. Or if you would like to read his words and see what stocks he's buying, there is a promotional offer, cabotwealth.com/street. It's 50% off the normal price. Tyler, thank you for joining me.